Well, clearly the market's back at new highs, and this has been driven largely by multiple expansion. It has not been driven by any upward revision in earnings. So in our mind, there might be some room for some cautiousness ahead, particularly as we go into earnings season for the third quarter. It's interesting to note, conferences are going on, healthcare, technology, industrials, conferences going on, and none of those companies have taken the opportunity to lower guidance. If they wanted to blame the macro, they could have, but they haven't quite yet. So interesting dynamic. Typically, this is a good time for companies to update guidance, and we haven't yet seen that. But I would say, we have trade that's getting resolved to some extent, but we still have tariffs in place. We still have tariffs in place, and they're still negatively impacting the end markets.
So, Brian, it's a pretty complicated situation here. And we can talk a lot about secondary risks like Iran, Russia, North Korea, Brexit. But the big risk and the thing I'm focused on is still China-U.S. trade tensions. I look at the last week and a half of a rally, and it's been a heck of a rally, however you look at it. Interest rates up, value stocks cruising. And unfortunately, I can't say that it's sustainable until you get some sort of meaningful softening or even resolution of the trade talks. I mean, this rally is based on last week both sides coming together and agreeing to meet. That is the bare minimum as far as a step forward. There's no agenda set. Yes, there is. President Trump put out a 2-week delay in the tariffs last night. That's meaningless as well. We are a long way from resolution. Now, with that having been said, I don't think this is a time that you sell because this market is so volatile. It could easily go up further as well as go down. And the thing to do in this situation, in my opinion, is go for cash flow generating companies, stocks that are buying back their shares, companies that are increasing their dividends. That's a sign of how healthy they are and how they can make it through thick or thin, whatever the latest Trump tweet is or whatever the latest missive is from the Global Times in China. I think I got that newspaper right. So look at cash flow generating companies. Look at the Intels of the world. Look at Cisco Systems, just to name a couple.
Josh, I mean, what do you view as the biggest risk right now for stocks?
The biggest risk for stocks?
Because it's been the last couple days, last 7 days, there's been just risk off. We're not talking about the risk we were talking about 3 weeks ago.
Risk on.
Yeah, 3 weeks. 3 weeks. Thank you.
You're welcome.
It's a long day. 3 weeks ago, it was all risk. It was all fear. Yeah. Suddenly now everything's fine. Yeah. What's changed?
So, well, first of all, if you're making investments based on the headlines of the day, you should give the money to somebody else who's a professional. That's one. Two, if you're somebody that thinks that trade has now been resolved, or you believe in a tweet about trade, or somebody from the White House saying we're going to have a meeting, we're not going to have a meeting, like if that's the basis behind which you then log into a brokerage account and buy or sell something, once again, give the money to somebody else. Big picture, the most important thing going on right now, Brian, to answer your question, is the value momentum switch. Like the question on every professional's mind right now is, are there legs to this? Is it this just about rates backing up and then maybe one side of the trade being too crowded? Or is this the start of something bigger? And I want to give you some numbers that I found mind-blowing today. The Dow Jones Market Neutral Value Index had its best day on Monday since inception, going back to 2001. Just an absolute monster move, 3.5% in one day. That is a market neutral index. It is not meant to do that. Then you go ahead and take a look at what's going on with momentum.
What does that tell you?
Hold on. When you take a look at what's going on with the market neutral momentum index, on the other hand, its worst 2 days in 10 years, down 4.5% Monday, then another 4% Tuesday. So if you're an investor right now and you look at your portfolio and you find a huge overweight toward momentum, a huge overweight toward growth, A, you really felt it this week negatively, and B, you might want to look at your asset allocation and ask yourself, have I been ignoring too many sectors in the market? Am I not exposed enough to value stocks? And if that's the case, this might be the wake-up call that you needed. And I got to tell you one last thing on this. I'm very hopeful that this is the beginning of a sea change because, to Joe's point, breadth has been good. Advanced decline, as he pointed out yesterday, hit a new all-time high. We want to see these value stocks back in the game. We want to see them within 5 and 10% of new all-time highs, not 20% away, if this market's going to continue higher. So to that point, I think it's a very positive development to get that rotation this week, and I hope it's not a short-lived thing.